You work hard for your money, right? And the last thing you want to do is give a huge chunk of it away to the government. But taxes are a fact of life, and ignoring them can really hurt you in the long run. That's why in this video, we're diving deep into tax optimization strategies that can help you keep more of what you earn so you can invest more, build wealth faster, and achieve financial freedom sooner. We're talking about the kind of stuff that can save you thousands, even tens of thousands of dollars over time. Whether you're just starting out on your financial journey, or you're already a seasoned investor, these strategies are absolutely essential for maximizing your wealth building potential. So if you're ready to take control of your finances and start paying less in taxes, stick around because we're about to break it all down, step by step. One of the most straightforward ways to reduce your taxable income is by contributing to tax-advantaged accounts. These accounts are specifically designed to encourage savings and investment by offering you some pretty sweet tax benefits. Think of them like a secret weapon in your financial arsenal. Now, there are two main types of tax-advantaged accounts you need to know about. First up, we've got retirement accounts like the 401(k) and the Roth IRA. These are your best friends when it comes to saving for retirement. Why? Because they let your money grow tax-free or tax-deferred, which can make a huge difference over the long term. Let me give you an example. Let's say you're in the 25% tax bracket, and you contribute $10,000 to a traditional 401(k). That's $2,500 less in taxes you have to pay right off the bat. Plus, your money grows tax-deferred, meaning you won't pay taxes on any of the gains until you retire. That's a double whammy of tax savings. Next, we've got health savings accounts, or HSAs. These are like triple tax-advantaged accounts. You contribute pre-tax dollars, your money grows tax-free, and you can withdraw it tax-free for qualified medical expenses. It's like a trifecta of tax savings, especially if you're young and healthy and don't anticipate having a lot of medical expenses in the near future. But here's the catch with all these tax-advantaged accounts: there are contribution limits. Make sure you check the IRS website for the latest limits because they can change from year to year. But the bottom line is, the more you can contribute to these accounts, the more you can reduce your tax burden and keep more of your hard-earned money working for you. Now let's talk about tax deductions and credits. These are like little gifts from the IRS that can help you save a ton of money on your taxes. But here's the thing, a lot of people get deductions and credits confused and they end up leaving money on the table. So let's clear things up. A tax deduction reduces your taxable income. Think of it like a discount on your income before taxes are calculated. Let's say you're in the 25% tax bracket and you qualify for a $10,000 deduction. That means you're reducing your taxable income by $10,000, which translates to $2,500 in tax savings. A tax credit, on the other hand, is a dollar-for-dollar reduction in the amount of taxes you owe. So, if you qualify for a $1,000 tax credit, it directly reduces your tax bill by $1,000. No complicated calculations, just straight-up savings. Now, there are tons of different deductions and credits out there, and the ones you qualify for will depend on your individual circumstances. Some common deductions include the standard deduction, itemized deductions for things like mortgage interest and state and local taxes, and deductions for student loan interest. As for credits, some popular ones include the child tax credit, the earned income tax credit, and the American Opportunity Tax Credit for education expenses. The key is to do your research and figure out which deductions and credits you're eligible for. Don't be afraid to consult with a tax professional if you need help navigating the complexities of the tax code. Remember, every dollar you save in taxes is a dollar you can invest and grow. Here's the thing about investing. It's not just about how much money you make, it's about how much money you keep after taxes. That's where tax-efficient investing comes in. It's all about choosing the right types of accounts to hold your investments in, so you can minimize your tax liability and maximize your returns. One of the most tax-efficient accounts you can use is a Roth IRA. Contributions to a Roth IRA are made with after-tax dollars, but here's the beauty. Your money grows tax-free and you don't pay any taxes on withdrawals in retirement. That means all those years of compounding growth are completely tax-free. Another great option is a health savings account, or HSA. As we talked about earlier, HSAs offer a triple tax advantage. Contributions are tax-deductible, your money grows tax-free, and withdrawals for qualified medical expenses are tax-free. But here's the kicker. You can also use your HSA for investments, just like a 401k or IRA. Now, if you've maxed out your tax-advantaged accounts and you're looking for other tax-efficient options, consider investing in index funds or ETFs that are known for their tax efficiency. These funds typically have low turnover rates, which means they generate fewer taxable events. And here's a pro tip: be mindful of wash sales. That's when you sell an investment at a loss and then buy back the same or a substantially similar investment within 30 days before or after the sale. The IRS doesn't like it when you do that, and they'll disallow the loss, which can mess up your tax strategy. Chapter 4. Understand long-term versus short-term capital gains. Let's talk about capital gains taxes. These are the taxes you pay when you sell an investment for a profit. But here's the thing, not all capital gains are taxed the same way. There's a big difference between short-term and long-term capital gains, and understanding that difference can save you a ton of money. Short-term capital gains are taxed as ordinary income, which means they're taxed at your regular income tax rate. So if you're in the 25% tax bracket, you'll pay 25% in taxes on any short-term capital gains. Long-term capital gains, on the other hand, are taxed at a lower rate. The exact rate depends on your income level, but it's generally much lower than your ordinary income tax rate. For example, if you're in the 25% tax bracket, you might only pay 15% on your long-term capital gains. So, what's the difference between short-term and long-term? It all comes down to how long you hold the investment. If you hold an investment for 1 year or less before selling it, any profit you make is considered a short-term capital gain. But if you hold the investment for more than a year, it's considered a long-term capital gain. The takeaway here is simple. If you can, hold on to your investments for longer than a year to take advantage of those lower long-term capital gains tax rates. It's a simple strategy, but it can make a huge difference in your overall returns. Consider the tax implications of different income sources. Not all income is created equal in the eyes of the IRS. Different types of income are taxed in different ways, and understanding these nuances can help you optimize your tax strategy. Let's start with earned income. This is the money you earn from your job, whether it's a salary, wages, or self-employment income. Earned income is taxed at your ordinary income tax rate, which, as we discussed earlier, can be pretty high depending on your income level. Next, we've got investment income. This includes things like dividends, interest, and capital gains from the sale of investments. Investment income is taxed differently than earned income, and the tax rates can vary depending on the type of investment income and your holding period. For example, qualified dividends, which are dividends paid by U.S. corporations or qualified foreign corporations, are taxed at the lower long-term capital gains rates. Non-qualified dividends, on the other hand, are taxed as ordinary income. Then, there's passive income. This is money you earn from sources that require minimal effort on your part, such as rental income or royalties. Passive income is generally taxed at your ordinary income tax rate, but there are some deductions and credits available that can help reduce your tax liability. The key takeaway here is to diversify your income streams and be mindful of the tax implications of each. By understanding how different types of income are taxed, you can make more informed investment decisions and minimize your overall tax burden. Stay up to date on tax law changes. Here's the thing about tax laws. They're constantly changing. What might be a great tax strategy 1 year could be completely obsolete the next. That's why it's so important to stay up to date on the latest tax law changes. One way to stay informed is to subscribe to reputable financial publications and websites. These outlets often have dedicated sections on taxes, and they'll publish articles and updates whenever there are significant changes to the tax code. Another great resource is the IRS website. I know the IRS website can be a bit of a snooze fest, but it's actually a treasure trove of information on all things tax-related. They have publications, FAQs, and even interactive tools that can help you understand your tax obligations. And of course, don't be afraid to consult with a tax professional. A good CPA or enrolled agent can help you navigate the complexities of the tax code and develop a personalized tax plan that minimizes your tax liability. Think of it like an investment in your financial future. Remember, the tax code is complex and constantly evolving. By staying informed and seeking professional guidance when needed, you can stay ahead of the curve and make sure you're always taking advantage of the latest tax optimization strategies. So there you have it, guys. We've covered a lot of ground today, but the key takeaway is this: tax optimization is an essential part of building wealth and achieving financial freedom. By implementing the strategies we discussed today, you can keep more of your hard-earned money, invest it wisely, and watch your wealth grow over time. Remember, every dollar you save in taxes is a dollar you can invest and grow. So, take action today, start implementing these strategies, and watch your financial future brighten up. As always, thanks for watching, and I'll catch you in the next one.